Have you ever wondered what a portfolio built for pure, aggressive growth really looks like on the inside? Well, today we're grabbing the blueprints and tearing it down, piece by piece. We're going to dissect its core identity, unpack the why behind its design, and see what it all means for you. Okay, let's jump in.
So, let's just start with the big question. If your one and only goal was to build a portfolio for maximum possible growth, where would you even start? What would you put in it? What would you leave out? That's the exact problem this strategy is designed to solve.
So here's our game plan. First, we'll cover the portfolio's core identity. Then we'll get into the why behind the numbers. After that, we dive deep into the nuts and bolts of the allocation itself, and we'll wrap up with what it all means in the real world, the risks, the rewards, and whether it could be right for you.
All right, first up, let's take that 30,000-foot view. To really get what this strategy is all about, we have to look at the two big-picture traits that define its entire personality, long before we zoom in on the details.
Wow. Okay, right off the bat, what's so striking here is just how bold this is. A massive 65% of the entire portfolio is dedicated to growth stocks. This isn't a strategy that's hedging its bets. It's making a powerful, high-conviction statement about the future. Yeah, you see value and momentum in there playing their part, but there is absolutely no question who the star of this show is.
And the second piece of its DNA is how it spreads that big bet across different-sized companies. Exactly half is anchored in large caps, the big, stable household names. That's the foundation. But then, look at this. It takes the entire other half and splits it between the higher octane worlds of mid and small cap stocks. That blend of stability and pure firepower is it's everything to the strategy.
Okay, so we know the what, now let's get into the why. We're moving from just looking at the blueprints to understanding the philosophy, the actual thinking that led to these very specific decisions.
So this whole thing really stands on four main pillars. You've got that huge growth bias, which is all about capturing those big game-changing trends. You have the market cap diversification we just saw, which mixes that stability with raw potential. Then there's this momentum factor for riding market trends. And last, a small but really critical value anchor just to keep things balanced.
I love this slide because it explains the core dynamic perfectly. Just think of it like a football team. That huge 65% chunk in growth, that's your offense, out on the field, trying to score touchdown after touchdown. And that smaller 15% in value, that's your defense, trying to protect the lead and bring some stability when the other team starts making a comeback. They need each other to win.
Now that third piece of the puzzle, momentum, might be a little less familiar to some of you. The idea is actually super simple. It's based on the observation that things that have been going up in price tend to keep going up, for a while anyway. And the reverse is also true. So this is just a systematic way of trying to ride those waves instead of fighting against them.
All right, it's time to pop the hood and get our hands dirty. We're going deep inside the machine now to see exactly how those factors, growth, value, and momentum, are actually spread out inside each of those company sizes we looked at earlier.
So let's start with the foundation, the 50% in large caps. As you can see, even this quote-unquote safe part of the portfolio has its own aggressive engine running. A huge slice goes to large cap growth, a smaller piece to value, and then a really significant 20% is dedicated to finding momentum trends among these market giants. So yeah, this is the stable core, but it is not asleep at the wheel.
Next up, we've got the mid-caps, a full quarter of the portfolio. People call this the Goldilocks zone, right? The companies aren't too big to be nimble, but they're not too small to be super fragile. Here, the strategy puts 10% in mid-cap value, probably hunting for some bargains, while the other 15% is laser-focused on finding those exciting growth and momentum stories in this really dynamic part of the market.
And finally, we get to the most aggressive slice of the pie, the 25% in small caps. Now look closely. Notice what's missing? That's right. There is zero allocation to value here. Zilch. This part of the portfolio is focused on one thing and one thing only: raw potential. You've got a massive 20% in small cap growth and another 5% chasing momentum. This is the portfolio's pure rocket fuel.
So, we've seen the architecture, and we get the philosophy. Now, it's time for the reality check. What does this aggressive design actually mean when the rubber meets the road? Let's talk about the risks, the potential rewards, and who a strategy like this is actually for.
So here's the absolute bottom line on this. This portfolio is what you might call a fair weather champion. In a bull market, when everything is going up, this thing is engineered to go up even more. But, and this is a really big but, when things turn sour in a bear market, its limited defense means it's designed to fall further and faster than everything else. It's the absolute definition of high risk, high reward.
So what's the potential prize for taking on all that extra risk? Well, the projected long-term annual return is in that 10 to 14% range. Now, just to give you some context, the historical average for a plain vanilla index fund is more like 8 to 10%, so this is aiming for something significantly bigger.
But here's the price of admission for that potential return. The expected annual volatility, which is just a fancy way of saying how wild the ups and downs are, is between 18 and 22%. A more typical portfolio might be around 15 or 16%. So this strategy doesn't just promise a potentially faster destination, it guarantees a much, much bumpier ride to get there.
Which, of course, leads us to the biggest question of all. Who is this actually for? Well, the ideal person has a very long time horizon. We're talking 10 years minimum. They have to have a genuinely high tolerance for risk. And maybe most importantly, they need the stomach to be able to watch their portfolio drop 20, maybe even 30% without hitting the panic button. This is absolutely not for the faint of heart.
And that really brings us to our final thought. You know, we've deconstructed one very specific strategy today, but the principles of risk and design, well, they apply to everyone. So the real question I want to leave you with is this. Is the level of risk you're taking in your own portfolio truly aligned with your long-term goals? And just as importantly, is it aligned with your ability to sleep soundly at night?